Michael Burry has just made a $24 million bet on China's tech giants. Is he seeing something we're not? Let's investigate the numbers, the risks, and the potential payoff of Burry's bold China gamble. Burry isn't just any investor. He's the man who correctly predicted the 2008 financial crisis, making him a legend in the investment world. His track record for spotting opportunities where others see danger is impressive. So when he makes a big move like this, people take notice. But why China? And why now? The country's economy has been struggling with a real estate crisis, slowing growth, and declining consumer confidence. Yet Burry is pouring millions into Chinese tech stocks. What does he see that others are missing? Is this a genius move that could lead to massive profits, or a risky gamble that could backfire spectacularly? The stakes are high, and the potential implications for global markets are significant. While many see China's economy as a house of cards ready to collapse, the reality might be more complex. What if the world's second-largest economy isn't on the brink of disaster, but on the cusp of a major transformation? China's recent economic struggles have captured global attention, raising concerns about its stability and future prospects. But as we dig deeper into the numbers and trends, a more nuanced picture emerges. Let's start with the challenges. China's economy is currently facing a perfect storm of issues. The real estate sector, long considered a pillar of China's economic growth, is in crisis. Major developers are defaulting on their debts, leaving a trail of unfinished projects and unsold apartments. This isn't just a problem for homeowners and investors. It's a systemic issue that threatens local government finances and overall economic stability. Adding to these woes is China's sluggish GDP growth. The government set a target of about 5% for 2023, but recent data suggests the economy is struggling to meet this goal. The end of the zero-COVID policy, which many hoped would jumpstart the economy, hasn't delivered the quick recovery many expected. Instead, we're seeing a slow, uneven rebound that's raising eyebrows among economists and investors alike. But here's where things get really interesting. China's total debt stands at a staggering 282% of GDP. To put that in perspective, it's significantly higher than the United States' 256%. This level of debt is raising alarms about China's economic fragility. It's not just government debt we're talking about. This figure includes debt from individuals, businesses, and the government. The sheer scale of this debt burden is unprecedented for a developing economy like China's. These problems aren't isolated, they're interconnected in ways that create a potentially dangerous feedback loop. As consumer confidence declines, spending drops. This leads to overcapacity in industrial production, which in turn can cause falling prices, insolvency, and job losses. It's a cycle that economists fear could spiral into a full-blown economic crisis. A recent survey highlighted this declining consumer sentiment. Only 39% of Chinese respondents felt financially better off compared to 5 years ago. This is a significant drop and signals a broader loss of faith in the country's economic prospects. When consumers lose confidence, they spend less, save more, and economic growth inevitably slows. China's industrial policies have historically favored production over consumption, resulting in structural overcapacity. While this approach fueled rapid growth in the past, it's now becoming a liability. The lack of robust consumer spending is hampering economic recovery efforts, creating a mismatch between production capacity and domestic demand. However, it's crucial to note that not everyone sees doom and gloom in China's economic future. Some analysts argue that what we're witnessing isn't a crisis, but rather a typical economic cycle. They point out that China has a range of tools at its disposal to stabilize growth and address these challenges. The Chinese government has shown in the past that it's willing and able to intervene in the economy to maintain stability. This brings us back to Michael Burry's surprising bet on China. Despite all these apparent red flags, Burry has chosen to invest heavily in Chinese tech stocks. His track record of spotting opportunities where others see only danger makes this move particularly intriguing. Could Burry be seeing potential for a dramatic turnaround that others are missing? Michael Burry's recent investment moves have sent shockwaves through the financial world, but the real story lies beneath the surface. While his bet on China grabs headlines, It's the drastic reshaping of his entire portfolio that paints a more complex picture of his economic outlook. Burry, known for his prescient predictions, has made a series of bold moves that seem to defy conventional wisdom. But what do these changes really tell us about his view of the global economy? Let's start with the numbers, and they're eye-opening. Burry has dramatically reduced his overall stock holdings from a whopping $102 million to just $53 million in the third quarter of 2023. That's nearly a 50% reduction in his equity exposure. This isn't just a minor adjustment, it's a massive overhaul of his investment strategy. But why such a drastic cut? The answer lies in the details of his portfolio restructuring. Burry has significantly decreased his investments in sectors traditionally seen as sensitive to economic cycles. He's pulled back from consumer discretionary stocks, which are often the first to feel the pinch when consumers tighten their belts. Even more telling, he's slashed his banking stocks by a staggering 90%. This move suggests Burry might be anticipating turbulence in the financial sector. But here's where things get really interesting. While Burry is reducing his exposure to U.S. stocks, he's simultaneously increasing his bets on Chinese tech stocks. In fact, these now make up 46% of his portfolio. It's a stark contrast to his overall reduction strategy and raises some intriguing questions about his economic outlook. Burry's largest holding is now Alibaba, which comprises 21% of his portfolio. He's increased his stake in the Chinese e-commerce giant by 24%, acquiring an additional 30,000 shares. This isn't just dipping a toe in the water, it's a full-scale plunge into the Chinese tech sector. But Alibaba isn't his only Chinese bet. Burry has also boosted his stake in Baidu, China's leading search engine, by an impressive 87.5%. So what are we to make of these seemingly contradictory moves? On one hand, Burry is battening down the hatches, reducing his overall stock exposure, and steering clear of sectors that could be hit hard in an economic downturn. On the other hand, he's making a significant bet on Chinese tech companies, which have faced their own challenges in recent years. This strategy suggests that Burry isn't just pessimistic about the global economy. He's also seeing unique opportunities in China's potential recovery. It's a nuanced view that goes beyond simple doom and gloom predictions. Burry seems to be positioning himself for a world where traditional safe havens might not be so safe, while beaten-down sectors in emerging markets could offer surprising upsides. It's important to note that Burry isn't completely abandoning the U.S. market. As one analyst pointed out, Michael Burry is not going short on the market today like he was heading into the 2008 financial crisis. Overall, he remains positioned on the long side. This suggests that while Burry is cautious, he's not predicting a catastrophic meltdown like the one he famously foresaw in 2008. Instead, Burry's moves point to a more subtle recalibration of global economic power. His heavy investment in Chinese tech stocks could indicate a belief that these companies are undervalued and poised for a comeback. As one expert noted, Burry believes these low prices are a great buying opportunity and probably believes that this pessimism is overdone. This strategy aligns with Burry's reputation as a contrarian investor. While many are fleeing Chinese stocks due to regulatory crackdowns and economic uncertainties, Burry is doubling down. It's a high-risk, high-reward approach that has paid off for him in the past. Burry's bold bet on China isn't just about going against the crowd. It's based on a little-known metric that suggests Chinese stocks are at their lowest relative value in over 15 years. What does Burry see that others are missing, and could this be the investment opportunity of the decade? Michael Burry's contrarian approach to investing has made him a legend in financial circles. His latest moves in the Chinese market are raising eyebrows and prompting questions about what he sees that others don't. Burry's strategy is rooted in the concept of contrarian investing, which involves taking positions opposite to the prevailing market sentiment. In this case, while many investors are fleeing Chinese stocks due to economic uncertainties, Burry is doubling down. The numbers behind Burry's bet are striking. Chinese stocks are currently at their lowest price relative to U.S. stocks in over 15 years. This valuation gap suggests that Chinese stocks may be significantly undervalued compared to their historical performance. It's this disparity that Burry seems to be capitalizing on, seeing an opportunity where others see risk. Burry's specific bets in the Chinese market are equally noteworthy. He's increased his holdings in Alibaba by 24% and his stake in Baidu by a whopping 87.5%. These aren't small, cautious moves. They represent a significant shift in his portfolio and a strong vote of confidence in China's tech sector. But what's driving this confidence? Burry's average cost per share for his Alibaba investment is estimated at $78.83. Recently, the stock price has surged to around $105, indicating a potential gain of approximately 34%. This performance suggests that Burry's contrarian approach may already be paying off. Burry's strategy is reminiscent of his approach during the 2008 financial crisis. Back then, he invested in sectors that were facing severe challenges, believing they would eventually rebound. His current investments in Chinese tech stocks follow a similar pattern. He's betting on companies that have faced regulatory crackdowns and economic headwinds, believing that these challenges are temporary and that the sector is poised for a comeback. This approach isn't without risks. Contrarian investing relies on the belief that markets will correct over time, but there's no guarantee when or if this will happen. Burry's investments could face significant volatility in the short term, and there's always the possibility that the Chinese economy could face more severe challenges than anticipated. However, Burry's track record of spotting opportunities where others see only danger makes his current strategy particularly intriguing. His willingness to invest heavily in a market that many are avoiding suggests he sees potential for a dramatic turnaround that others are missing. Burry's moves also reflect a broader reassessment of China's economic position. While many analysts focus on the country's current challenges, Burry seems to be looking beyond these short-term issues. His investments suggest he believes the pessimism surrounding China's economy is overblown, presenting a unique opportunity for investors willing to go against the grain. This contrarian view raises important questions about the global economic landscape. If Burry is right, we could be witnessing a significant shift in economic power. His bets on Chinese tech giants like Alibaba and Baidu could be early indicators of a resurgence in China's tech sector and broader economy. While Burry's investments grab headlines, China's own economic rescue plan is flying under the radar. From slashing mortgage rates to propping up the stock market, Beijing is pulling out all the stops. But will these desperate measures be enough to save the world's second-largest economy? China's government isn't sitting idle as economic challenges mount. They've launched a massive intervention strategy, injecting a staggering $141 billion into the financial system. This isn't just throwing money at the problem, it's a calculated attempt to jumpstart growth and restore confidence in key sectors. One of the main targets of this economic lifeline is the struggling real estate market. The government has cut mortgage rates and reduced down payment requirements, making it easier for families to buy homes. This move aims to revitalize a sector that's been a major drag on China's economy in recent years. But the support doesn't stop there. China has also introduced new tools to prop up its stock market and help companies access funding. These measures are designed to stabilize the economy and put it back on track to meet growth targets. So why all this government intervention? It's simple. China needs to restore consumer confidence and stimulate economic activity after a period of stagnation. When people feel uncertain about the future, they tend to save rather than spend, creating a vicious cycle that can further slow economic growth. Early signs suggest these measures might be having an impact. Chinese stock prices have started to rebound, with tech giants like Alibaba seeing a 20% increase and JD.com up by 35%. These are the kinds of companies Burry has been investing in, suggesting his strategy might be aligning with China's own efforts to boost its economy. The Chinese government isn't just hoping for the best, they've set ambitious goals. They're aiming for a growth target of about 5% for 2024, and these interventions are crucial for achieving that objective. It's a high-stakes game with global implications if China succeeds or fails in its economic recovery. Analysts are cautiously optimistic about these measures. They expect that the supportive policies in real estate and consumption will contribute to a continued upward trend in A-shares, potentially benefiting investors like Burry who've taken positions in Chinese companies. But here's where things get really interesting. While government intervention can provide a short-term boost, The real question is whether it can address the underlying structural issues in China's economy. Can these measures transition China from an export-driven model to one more balanced with domestic consumption? That's the trillion-dollar question that will determine the long-term success of both China's economy and Burry's investment strategy. It's also worth considering the potential downsides of such massive government intervention. While it can provide a much-needed boost in the short term, it also raises concerns about creating market distortions and potentially delaying necessary reforms. There's a delicate balance between supporting the economy and allowing market forces to play their role in driving efficiency and innovation. Moreover, the success of these measures relies heavily on how they're perceived by both domestic and international investors. If confidence in China's economic management increases, it could lead to a virtuous cycle of investment and growth. However, if these interventions are seen as a sign of desperation while China's rescue attempts grab headlines, a darker reality threatens to unravel it all. Is Burry walking into a trap that could swallow his millions? The answer lies in a web of economic and political factors most investors overlook. Michael Burry's bold bet on Chinese stocks has certainly turned heads, but it's not without significant risks. The potential for these investments to become value traps looms large, especially if China's economy fails to recover as anticipated. What exactly is a value trap? It's a situation where stocks appear cheap based on traditional metrics, but fail to recover due to underlying economic issues. This is a real concern for investors in Chinese companies right now. The ongoing real estate crisis, for instance, could continue to drag down the performance of tech giants like Alibaba and Baidu, even if their stock prices seem attractive at first glance. China's economic strategies have led to serious overcapacity issues, which could result in ongoing financial instability. Companies heavily reliant on domestic consumption might struggle to find their footing in this environment. This overcapacity problem isn't just a short-term hiccup. It's a structural issue that could take years to resolve, potentially keeping stock prices depressed for an extended period. But the risks don't stop at economic factors. Political and regulatory issues pose significant threats to foreign investments in Chinese companies. The Chinese government has a history of sudden crackdowns on various sectors, including tech. These interventions can dramatically impact stock prices and company operations overnight. For investors like Burry, this regulatory uncertainty adds an extra layer of risk to an already complex investment landscape. Transparency is another major concern when investing in Chinese firms. Data reliability and corporate governance standards often fall short of what Western investors expect. This lack of transparency makes it challenging to accurately assess a company's true financial health and future prospects. It's like trying to navigate a ship through fog. You might think you're on the right course, but hidden obstacles could be just out of sight. The combination of these factors, economic instability, regulatory risks, and transparency issues, creates a perfect storm of uncertainty for investors. Even if China's economy shows signs of recovery, these underlying problems could continue to suppress stock prices and limit potential gains. So why would a savvy investor like Burry take such a risk? It's likely he's factored these concerns into his decision-making process. Burry's track record suggests he's not one to overlook potential pitfalls. His approach often involves identifying opportunities where the perceived risk is higher than the actual risk, based on his in-depth analysis. Burry's strategy might be banking on China's ability to overcome these challenges in the medium to long term. He could be seeing potential for significant reforms that could address some of these structural issues. Or perhaps he believes the current pessimism surrounding Chinese stocks is overblown, creating an opportunity for outsized returns if sentiment improves even slightly. It's also worth considering the global context of Burry's bet. With many investors fleeing Chinese stocks, prices have been driven down to levels that might be too attractive to ignore, even with the associated risks. If China's economy does manage to stabilize and grow, early investors like Burry could see substantial returns. However, the stakes are undeniably high. If China's economic troubles prove more persistent than anticipated, or if regulatory crackdowns intensify, even Burry's careful calculations could be thrown off course. The potential for significant losses is very real, especially given the size of his investment. Ultimately, Burry's bet on China is a high-risk, high-reward proposition. It's a testament to his confidence in his analysis and his willingness to go against the grain of market sentiment. But it's also a stark reminder of the complexities and uncertainties inherent in investing in emerging markets, especially one as unique and influential as China. While risks loom large, the potential payoff of Burry's China bet shouldn't be overlooked. If Chinese stocks follow a similar trajectory to U.S. equities after the 2008 crisis, we might witness a financial turnaround of historic proportions. What would this mean for global markets? Michael Burry's investment in Chinese stocks has raised eyebrows, but it's the potential returns that are truly eye-opening. If his bet pays off, early investors could see substantial gains as China's economy rebounds. The comparison to the recovery of U.S. stocks after the 2008 financial crisis is particularly telling. Following that crisis, many U.S. stocks saw dramatic increases in value, rewarding investors who had the foresight, or perhaps the courage, to invest during uncertain times. China's current economic situation bears some similarities to the U.S. in 2008. There's widespread pessimism, undervalued assets, and a general sense of economic malaise. But if China's economy stabilizes and begins to grow again, the potential for a sharp increase in stock values is significant. Undervalued Chinese stocks could experience a rapid appreciation, similar to what happened in the U.S. market post-2008. The numbers are already starting to tell an interesting story. Burry's investment in Alibaba, for instance, has seen significant gains. His average cost per share was around $78.83, but the stock recently hit $105. That's a potential gain of 34% in a relatively short period. If this trend continues or accelerates, the returns could be substantial. But the impact of a Chinese economic recovery wouldn't be limited to stock prices. China's role in the global economy means that its recovery could have far-reaching effects. The International Monetary Fund notes that an increase in China's growth rate by just 1 percentage point could add 0.3% to global economic growth. That might not sound like much, but in the world of global economics, it's a significant figure. A resurgent Chinese economy could boost global trade, increase demand for commodities, and potentially kickstart growth in other emerging markets. This could create a positive feedback loop, further fueling China's recovery and benefiting investors who got in early. It's also worth considering the potential impact on specific sectors. China's tech giants, like Alibaba and JD.com, could see particularly strong growth if consumer confidence returns and spending increases. These are exactly the types of companies Burry has invested in, suggesting he's not just betting on a general economic recovery, but on specific sectors he believes are poised for growth. The Chinese government's recent economic interventions could play a crucial role in this potential recovery. Measures like liquidity injections and mortgage rate cuts are designed to stabilize the economy and boost growth. If these policies have their intended effect, they could act as catalysts for economic recovery, further benefiting stocks like those in Burry's portfolio. However, it's important to remember that this is still a high-risk, high-reward scenario. The current economic environment in China, characterized by low consumer confidence and a sluggish recovery, contrasts sharply with the bullish outlook that Burry's investments imply. This disconnect highlights the speculative nature of these investments. Yet it's precisely this contrast that creates the potential for outsized returns. If the pessimism surrounding China's economy is indeed overdone, as Burry seems to believe, then the upside could be significant when sentiment eventually shifts. The potential payoff extends beyond just financial returns. If Burry's bet pays off, it could reshape perceptions of China's economic resilience and its role in the global economy. A strong recovery in China could challenge narratives about the decline of globalization and the shift of economic power away from Asia. Moreover, a Chinese economic resurgence could have geopolitical implications. Economic strength often translates to political influence on the global stage. A recovered and growing China might seek to play a larger role in international affairs, potentially altering the balance of global power. China's economic fate doesn't just affect its own citizens. Did you know that a single percentage point increase in China's growth could boost the entire global economy by 0.3%? This seemingly small number hides a shocking truth about how deeply China's economy is woven into the fabric of international trade. Michael Burry's investment in Chinese stocks isn't just a gamble on one country's future, it's a bet on the entire global economy. The interconnectedness of China with the rest of the world can't be overstated. China's role in global supply chains is massive. Think about it, almost everything you own, from your smartphone to your shoes, likely has components made in China. When China's economy sneezes, the rest of the world catches a cold. That's because China isn't just a manufacturer, it's also a major consumer market. Let's break down some numbers. China's economy accounts for a big chunk of global consumption. Major companies like Tesla, Apple, and Nike get a lot of their money from Chinese consumers. Tesla, for example, makes 20–25% of its revenue in China. Apple? They're pulling in about 15–20% from the Chinese market. These aren't small numbers, we're talking about billions of dollars. But it's not just about big tech companies. China's economic health has a huge impact on commodity prices. When China's growth slows down, it doesn't need as much steel, copper, or oil. This can cause prices to drop, affecting countries that rely on selling these resources. On the flip side, if China's economy picks up steam, it could drive up demand and prices for these commodities. The real estate crisis in China is a perfect example of how local issues can have global consequences. Chinese property developers are defaulting on their debts, leaving a trail of unfinished projects. This isn't just bad news for Chinese homeowners, it's a problem for anyone invested in these companies or in funds that hold their debt. The ripple effects can spread far beyond China's borders. China's debt situation is another red flag that has global implications. The country's total debt, including government, business, and individual debt, has hit 282% of its yearly GDP. That's higher than the US at 256%. This level of debt is unprecedented for a developing economy like China's. If China struggles to manage this debt, it could lead to a financial crisis that would be felt worldwide. But it's not all doom and gloom. China's government is taking steps to address these issues. They're injecting money into the financial system, cutting mortgage rates, and introducing new tools to prop up the stock market. These measures are designed to stabilize the economy and boost growth. If they work, it could lead to a resurgence in Chinese stocks and potentially benefit the global economy. This is where Burry's bet becomes really interesting. He's not just gambling on China's internal economic policies, he's betting on China's ability to maintain its crucial role in the global economy. If China's economy recovers and grows, it could lead to increased demand for imports from other countries, boosting global trade. It could also mean more Chinese tourists traveling abroad and spending money in other economies. However, there's a flip side to this coin. China's industrial policies have led to overcapacity in many sectors. As U.S. Treasury Secretary Janet Yellen warned, China is simply too large for the rest of the world to absorb this enormous capacity. This overcapacity could lead to price wars and destabilize global trade if not addressed properly. The stakes are high and the potential outcomes are varied. A strong Chinese recovery could lead to a resurgence in global markets, particularly in commodities where China's appetite significantly drives prices. On the other hand, if China's economy stumbles, it could drag down global growth and cause financial turbulence worldwide. Burry's investment strategy seems to be based on the belief that China will successfully navigate these challenges and emerge stronger. If he's right, it could mean significant returns not just for him, but for anyone who followed his lead. But if he's wrong, the consequences could be severe, both for his investments and for the global economy. Michael Burry's investment strategy in China offers valuable lessons for investors. His approach emphasizes looking beyond negative headlines and conducting thorough research. Burry's contrarian thinking, which led him to invest in Chinese tech stocks when others were fleeing, highlights the importance of seeking value in unpopular markets. Individual investors can learn from Burry's method by adopting a similar mindset. This involves analyzing market cycles, being prepared for volatility, and maintaining composure amid market fluctuations. However, it's crucial to remember that bold investment moves come with significant risks. Proper risk management and a strong conviction in one's analysis are essential. As we consider Burry's bets on Chinese stocks, a question arises. Will his strategy pay off in the long run, and how might it reshape perceptions of China's economic resilience in the global market?